has been in denial about what we call the inflation Wolverine. They trotted this out in the pandemic, the raising inflation as a way to heal the economy like a friendly puppy dog. And inflation is not a friendly puppy dog, and you've got a confluence of dynamics, certainly in the United States. We do have a disordinately large number of people between 30 and 45 years old, way more than the prior group, who all of a sudden have discovered owning homes, owning cars, living somewhere besides the coastal cities. And those dynamics are not going to be stopped by this late attack by the Fed. In other words, they let this go on too long, and the market's just coming to terms with that. So I think it's just they're all in denial, and they're just now coming to terms with the beginnings of eliminating their denial.
What was interesting, I thought, was where there was some room for concern was the fact that Powell refused to rule anything out, and that left alive the possibility of possibly a 50 basis point move at the March meeting. That would suggest, if it comes, that the Fed is shifting maybe on how transitory it thinks this inflation phase is. I think you think it's going to be around a lot longer.
Yeah, we definitely do. And it just so much looks like the Vietnam War, Johnson's Great Society, and the Arab oil embargo in 73, 74. We had the pandemic war, we had the, Biden's Great Society, and now, and then the Saudi Spring cut the legs off the U.S. oil industry by taking the price to zero in April of 2020. So, and then you pile all these high number of people forming households in right behind that, and a shortage of houses and a shortage of cars. And that is the classic definition. Too many people with too much money chasing too few goods.
Bill, I want to get to the market action because as the market was moving yesterday on fairly high volume yet again, the CBC team was crunching the numbers on the type of January we've had, the worst on record for the NASDAQ, the worst since 2009 for the S&P, and the worst one since 2016 for the Dow. Does this symbolize anything? Because we still have another year that is packed with Fed decisions potentially. Does this suggest that we've got a market that will reverse over the course of 2022?
We're not really short-term market timers in the slightest, but we have felt from elevated price earnings ratios, extremely popular growth stocks, and all forms of financial euphoria, right? Everything from Reddit traders, Robinhood traders, meme traders, you name it. We've had every form of goofiness occur in the financial markets that we were headed for an extremely difficult period. And so as a firm, we're posturing that this will be like the 1970s, which is, a nasty bear market in 73, 74. And then it culminated with another bear market in 81, 82. And there were only certain ways to make money, and they were all pretty much attached to making money from inflation. In other words, turn the thing that's the negative into the positive. And you can see that in oil prices. You can see that in the price of homes. Inflation is taking over the investment dynamic. And that does not bode well because most everyone was in this euphoric, no minute interest rates and no inflation phase for so long they forgot what the other part looks like.
40-year high, a major shift from the Federal Reserve. The central bank is signaling it'll start raising interest rates in March for the first time in 3 years, part of an attempt to fight sky-high prices.
Against a backdrop of elevated inflation and a strong labor market, our policy has been adapting to the evolving economic environment, and it will continue to do so.
Higher interest rates mean borrowing money will get more expensive for consumers and businesses. Everything from home mortgages to car loans to credit card bills.
It influences the consumer by increasing that cost of borrowing, which makes them think more about their purchase decisions and the overall demand that we see in the economy.
The Fed's change in policy comes as inflation remains stubbornly high, thanks to a combination of snags in global supply chains and strong consumer spending on products.
The Fed's come around to the view that these price pressures are going to remain elevated much longer than they had initially anticipated.
The stock market edged lower on the Fed news after several days of wild swings. While Americans checking their 401k accounts might be jittery, analysts say there could be gains ahead.
The good news is, if you go back and look at all of the rate hike cycles that we've had going all the way back to 1950, the market has tended to do well after it starts.
Amid the market volatility, a long-term strategy is key.
It's going to be a bumpy road, but don't get pushed out of your diversified investment plans.
Now, even with borrowing costs expected to go up, rates remain at historically low levels. Many economists say it's unlikely that interest rates will reach double digits like in previous decades. Elizabeth Schulze, ABC News.